Good afternoon, everybody. My name is Samantha Hanson. I'm the National Sales Manager here at Pepper Money, and I'm joined by Andrew Miller, our Commercial Credit Manager here at Pepper Money, and we are providing you some education and training around our commercial offering today. We are going to be touching on a few specialised security types to provide you some deeper insights into these securities and what you can do with those. But before we kick off, I'll just throw over to Andrew so he can give us a bit of an intro.
Thanks, Samantha, and welcome everybody. As Samantha said, my name is Andrew. I lead the commercial credit team here at Pepper Money, specialising in commercial property finance, self-managed super funds, and some specialised property assets. Also get involved in some of the more complicated resi applications, but we're here to talk about our commercial offering today. So thank you and welcome. Looks like Samantha might have just frozen there for a moment, so if you can just bear with us, everybody. Nothing like a little technical hitch at the start of a presentation. So we've lost Samantha. Just bear with us. I'll see if I can bring up the presentation and present myself. Well, looks like we've got Samantha back. You just beat me to it. I was about to present the slideshow myself, Samantha, but you're back online? Frozen again? Sorry, everyone, just bear with us for a moment longer. Get the show back on track soon. Okay, Emily's now sharing the pack. Thanks, Emily. But I'll step in here and take over. So looking at our offering, obviously home loans is our bread and butter. We have prime through to specialist options, prime, near prime clear, specialist and specialist plus, with specialist and specialist plus being for clients that have had credit impairments, life events that affect their credit history. Commercial loans, we just have the prime and near prime products. specifically for commercial asset classes that we're funding. In self-managed super funds being a commercial offering with both residential and commercial properties, we have the near prime and prime offerings there as well, and in construction loans being prime and near prime as well. So if you have any queries around which particular product to set, we do have information on the broker portal, and your BDM is of course always very helpful and well willing to help assist in where that can be set. Can also send through to our credit scenarios and have an email response for early engagement. So what's the market currently telling us in terms of commercial property? Where is the market and what are we seeing at the moment? Certainly with a lot of international and global volatility in share markets and some of the more volatile investment options, we are seeing a flight to safer investments at the moment, and bricks and mortar being your basic safe haven for investments. So commercial property, that's what we're here to help with. Certainly seeing in pockets at least really strong demand for retail shop fronts in the performing strip type locations. They're outpacing office and industrial property. I'm still seeing some interest in office and definitely in the industrial space, but really in those vibrant pockets, retail shop fronts have taken over a little bit, certainly in terms of what we're seeing come through in terms of applications. Investors returning to the market, I think that if you turn back 6 or 9 months ago, a lot of people waiting to see what would happen with domestic markets and global markets, and people are now really taking the opportunity to invest rather than holding back. Commercial valuations, we are seeing a bit of stabilisation. More often than not, we're seeing what we expect to come through in our valuations. Of course, our valuations being our source of truth and what we're going to lend against in terms of our margins and LVRs. And it really is an exciting place to be at the moment, looking at what's happening in the market in commercial real estate and property finance. I'll just pause as we move on as well. I know that Samantha had a couple of IT issues. We do have Emily online to answer any questions that might come up in our question function within the presentation itself. So can do commercial. What are we here to do? We have a strong appetite up to $5 million in the commercial space. Having said that, if you've got an application client you're looking at north of $5 million, we do have appetite that's growing above that $5 million space. Engage your BDM early and we'll be able to work out a way forward. If you do have applications above 5 mil, that up to 5 mil is our bread and butter space. And with LVRs up to 80% and loan terms up to 30 years and 5 years interest only. So quite different from your traditional big bank offering. We'll look at shorter terms and loan renewals. We're happy to set and forget for up to 30 years, which will then free up a lot of cash flow for your investors. There is no commission clawbacks for early payouts for brokers, for yourselves. There is a 2% fee payable by the applicants themselves if they do terminate or repay the loan within a 3-year period, but no clawbacks for yourselves as brokers. Product features. So just splitting out the prime and the near prime offerings here, we do have both full doc and alt doc options available for you on prime and near prime offerings. On near prime, we can also look at 1-year assessment of financials in isolation. So where that works really well is if your client has had a really strong most recent financial year, and it will be more beneficial for us to assess their most recent year as opposed to the 2 years. We also have appetite in the near prime space for previous credit impairment, tax debts, and debt consolidation. We will talk a bit more about tax debts in some slides coming up, but we certainly have appetite in those spaces. We also have product features including an offset account and sub accounts. You can split loans, you can split For various reasons, it might be interest only and P&I. Additional repayments can be made. We have some very flexible cash out options and also redraw facilities. Now, in terms of our offering and what we can do to approach, I mentioned tax debts earlier. We have a very strong appetite for helping your clients out who may have an existing tax debt and to refinance that. We have seen a growing interest in this space since the tax office announced that the interest accrued on tax debts, tax liabilities, will no longer be an interest deduction on financials from the current financial year moving forward. So it would make a lot of business sense for a business that does have an outstanding tax debt to refinance that onto an interest deductible commercial loan. And we are here to help in that space and also in refinancing private loans. Just to distinguish a private loan from, say, a personal loan, private loans typically look like real estate agents' loans, potentially accountants, solicitors' loans, as opposed from a loan from an individual. So a private loan that has some sort of a loan schedule, may or may not have statements, but something in writing where we can understand how that loan was originated and the terms of the loan, we absolutely have appetite to refinance those. We'll look at credit impairments across various structures within a borrower group, the types of properties and locations, very strong appetite for Cat 1 and Cat 2 locations across the whole of Australia. And we'll consider Cat 3 locations, metro locations across the East Coast, and Canberra and Tasmania included there as well. Excuse me. A distinct difference in our commercial lending to what you might see out there in the market is we do not take a GSA over the trading business. So what does that mean? A GSA, a general security lodgement, is where we actually would otherwise, or the big banks you'll find it's pretty much mandatory, take a charge over the balance sheet. So we would actually just have our regard to the guarantees of the directors of the business and the asset that we are financing. We're not about to take a charge over the balance sheet, the business itself, which might have other implications for the owners of that business. As mentioned before, we do have interest only and P&I options. In terms of our service offering, as stated there, rapid response rates.
I'm back.
Hey, Samantha.
I'm
welcome.
so sorry. I had a technical issue. My computer just shut itself down and wouldn't restart. So thank you so much, Andrew, for filling in for me while that was happening.
Nothing like a technical hitch.
I love it. It's perfect.
Where
are we up to? We're rolling with it. Excellent.
I'm just about to talk up my team in terms of the service offering.
Perfect.
We're talking about our rapid response rates. All commercial applications that come to Pepper are assessed by the team that I manage. So you're talking about the one team, the one approach, and the one point of control for all commercial applications. Anything that's escalated or requires a bit more attention, that's what I'm on point for, to manage the team and to provide that service back to yourselves and to your clients. Annual reviews is also a big differentiator. So most places out there in the market, adjusted after the Carnell inquiry, any loans above $3 million will typically have an annual review where the big banks will go and ask the customers to provide all their financials and different declarations, tax portals, and it's almost like applying for a new loan every 12 months. I know how frustrating that can be for business owners. They just want to get on and manage their business, their property investment portfolio. If we do need to have some form of annual review, it's an internal annual review, which is behaviourally based. So we'll look at the performance of the loan and manage it internally. We're not going to go back to the customer and ask for all the ins and outs that you normally ask for in originating a new loan. You may as well go and shop it around if that's going to be the case. So trying to provide a simple one-touch approach for your customers in this space. And then if you do have a mixed deal, by mixed we're talking about that last bullet point there, both a residential property and a commercial property for the same customer, that'll be managed at the one point by my team as well. So you're not dealing across different teams for the residential loan, and then the commercial loan, all the one point of contact for you.
I think probably just before we move on, probably just to add to that as well, because it doesn't say it on the slide there, but 30-year loan terms.
Oh, yes.
For,
we did talk about that
commercial. You did?
Yeah, we talked about just before
there you go.
when we were trying to get back online.
Perfect. Awesome.
You know, we're not talking short-term finance. We've got to reset it at short-term expiry of 1, 2, 3, max 5 years. 30 years, lowers the loan repayments, frees up the cash flow for our borrowers.
Wonderful. Very good.
A great part of the offering.
Securities. So we've recently made some enhancements to policy now that we can cater for higher LVRs in the residential space. So we do take residential security as well when it falls outside of scope in our resi policy. So you'll see there that we can lift that LVR up to 85%. We do have 80% LVR for majority of your standard commercial type of securities. So your industrial units and warehouses, your mixed use, retail shop fronts, strata office and office showrooms and medical suites. And then we've got our specialised security types, which we are going to touch on in greater detail today. But you can see there the boarding houses, rooming houses and student accommodation also at 70%. You've got some mixed LVRs there based on whether it's a low care or high care for your NDIS, and your childcare centres and vacant industrial land as well, sitting at 65%. So all quite standard. You do find these LVRs within the product guide. And then we've also got a postcode tool for commercial that you'll find on the broker portal. When you pop in the postcode and suburb and you choose if it's a commercial product, you've also got a drop down to then jump into any specialised security types, and it will actually provide you the maximum LVR for that applicable commercial asset, and then also maximum loan limits that can be applicable as well, and that's for both full doc and off doc. All right, Andrew, NDIS deep dive. So we've always got a lot of brokers, lots of common questions that come through for NDIS. You know, it's not new, but it is still fairly new in the industry, I think, in terms of NDIS. And obviously everybody's gripping onto it because it does have such a great high rental income potential. So can you just explain, obviously there's different brokers on the webinar today have, I guess, a varying understanding of policy and what is and isn't acceptable for NDIS. Can you also just clarify for me, what is the difference between low and high care?
Yeah, thanks, Samantha. Great question. If you're not overly familiar with it, low care and high care is the way the NDIS system splits out the level of care that's required for the occupants of that property. And as the names would suggest, a low care would have a configuration for that property which provides a certain level of accessibility and care needs for those occupants, whereas high care would be people have an NDIS requirement that would require a greater level of fit out for that particular property, which will present as a different format internally and the access to the property, if you like. So low care, also referred to as improved livability, and then high care, fully accessible, often referred to as robust, and high physical support. So they will attract a different LVR and different lending appetite, generally 70% for your low care and 55% for your high care. The NDIS approval and the building approvals itself should be quite clear in what it is. Very occasionally, you might have a larger NDIS property, which will have different provisions within the same property. For those particular ones, happy to workshop them and find out where we would land for our offering and support for that. And at the end of the day, as for that last icon on the page, our valuation is going to be our source of truth. The experts will come out, examine the property and give us a detail around how that is configured. Sorry, Samantha.
I was just going to say, whilst we're on valuations, did you want to just touch on, I guess, rental income, how we calculate the rental income, how the valuations are done, given the type of security it is?
Yeah, absolutely. For NDIS properties, it being a commercial offering, we treat it the same way as we do for commercial property income, the rent being received. So we take the gross the gross income, the gross rental amount, less outgoings as stipulated in the tenancy agreement. So NDIS properties will have a formal tenancy agreement in place, and that's what we'll assess our serviceability against, which will include the outgoings.
Perfect. And then again, just to reference back to obviously metro postcodes or metro locations only, as I mentioned, always refer to that postcode tool because it's going to be your source of truth. And it's definitely something that you should also always start with for your commercial securities, because it'll just give you an understanding of where you go from there in terms of loan amount and so forth. Beautiful. Boarding houses. So again, we do get a lot of questions around boarding houses, particularly around income and the different names for boarding houses. So as you can see here, we've got the 3 different most common names: boarding house, rooming house, or co-living. First question, Andrew, would be: is there a difference between these? Is there anything that separates these different names, or is it all just the same building,
Yeah.
type?
Essentially, it's the same thing. They're just called different things from state to state. Obviously, boarding houses have an approval, a local government approval to be used and rented out as a boarding house, and those different states and territories have their own names for them. So, Victoria and Queensland call them rooming houses. We call them boarding houses in New South Wales. Essentially the same thing, and we assess them the same way. Just that, don't be confused about if it's a rooming house or a boarding house. They are essentially the same thing.
Perfect. And in terms of the income, and a lot of questions that we get asked is, a lot of the times there are vacancies within those dwellings. There might not be all rooms rented out at the same time for the whole year. So in terms of calculating income, what do we do in that? How do we approach that?
Yeah, another great question. And bearing in mind the nature of boarding houses, the tenancies aren't generally as long-term as you might find in some other asset classes out there. So what we'll do is we'll take the gross rent and apply it at 80%, which is effectively the same as what we do for residential investment. So take the full rent and just shade it by 80% to allow for any vacancies and the outgoings, including that 20% shading. It's a nice, simple approach.
Perfect. One last question on the boarding houses.
Can I add sorry, Samantha.
Yeah.
Just add as well, if there are vacancies at the point of application, we will take the lettable rent that is disclosed in the valuation. So again, coming back to valuation is our source of truth. We will take the market rent at that 80% with a 20% shading to account for that vacancy. Just to be clear on that.
So just off the back of that, then there's no instances that you would accept a rental appraisal. It would always be the valuation.
If actual rent is in excess of the market rent per the valuation, that's certainly something we take into consideration. And it would depend on the overall servicing scenario, how deep we need to dig into that and what we need to apply. Obviously, we're trying to make a deal work and find that solution. So we would consider that, yes.
Okay, beautiful. One last question. I would assume that we would need to have the building would need to be registered with the council to be an approved boarding house before we would take that as a security. Is there any instances where we can accept it without it being registered?
If we're going to treat it as a boarding house, it needs to be approved as a boarding house. If it's some other type of resi property that has council approval to be rented out in standard or non-standard terms, then that's fine. If it's not registered as a boarding house, we look at it as some other form of investment property, just depending on what it actually is in reality.
Okay, perfect. Okay. Another security type that we get a lot of questions on is vacant land. I think there's probably 2 main questions here for this one. What do we deem hard stand? And 2, can there be any buildings on the vacant land? Can they store anything on the vacant land? Anything at all? Can we get some clarity around those 2, please?
Yeah, sure. So let's start with what is hard stand. Hard stand is a block of land where you can use it for essentially storing vehicles, yellow goods. I've seen properties we're supported where construction companies using it to store their scaffolding and other bits and pieces of equipment. So outdoor usage, generally a flat level piece of land that can be rented out for those purposes, as opposed to somewhere which has a building constructed where you'd be storing or operating a business from within that building itself. Can we consider hard stand land where there is a building or an improvement? Yes, we can. Generally, the value of that would be discounted or removed from the valuation itself if it's, we're instructing it to be valued as vacant land hard stand. Minor improvements are shared. A demountable office, something like that, isn't uncommon and would not exclude it from being considered as a hard stand piece of security that we definitely have appetite for.
Great, beautiful.
I will add, just on that last point on this page, if it is in fact a development site, residential commercial development site, if highest and best use is as a development site, we just have to have regard for that. We don't have appetite for development sites per se, but if there's no intention to develop it, if we can get some understanding agreement from the borrower that they will not be developing it, and we can instruct the valuation to not have comparables at our development sites, and the valuer really has regard for it being a hard stand property, then we'd be able to progress with that.
That's great. That's good clarity around that, because it is another question that we get asked quite a lot on there as well. Wonderful, thank you. Okay, so we're going to run through some scenarios now, just to give you an understanding around these different asset types and some solutions that we've been able to provide in the past. So this is Richard, and he's looking to purchase an industrial property, and he wants to borrow $3 million on a property valued at $6 million as an investment and wants to minimise interest with an offset account. So in terms of income, Richard's building supplies business continues to trade well, which is confirmed by 2 years of tax returns and notice of assessment. He believes this is a good opportunity as the existing tenant will stay in the property for the remainder of the lease, and he may require additional space in the years to come as his business grows. Richard often receives large cash deposits that he can use to offset against the loan and is attracted to the 100% offset account and free online redraw. Since Richard is able to supply the most 2 recent years of tax returns and the NOAs, he qualifies for our Pepper Prime full dot commercial loan. With an LVR of 50%, Richard is able to borrow $3 million using a single security, and Pepper Money is able to offer Richard a 25-year loan term with 5 years interest only. So a great outcome for Richard there. So this is Cara, and Cara is looking to refinance a small commercial office. She wants to refinance $330K on a property valued $670, and Cara is also looking to refinance a tax debt of $100,000. Due to rent increases across her property portfolio, Cara's income has increased, but she failed to account for her tax obligations and seeking cash out to pay her tax debt in full. Cara does not have her most recent financials completed, but can verify her income by providing a declaration of financial position plus a Pepper Money accounts letter. Since Cara is able to supply an accounts letter, she qualifies for our Pepper Prime Alt Doc commercial loan. With an LVR of 64%, Cara is able to refinance a property and pay out her tax debt in full, and Pepper Money is able to offer Cara, once again, a 30-year loan term. So we have made some really exciting enhancements in the tech space across residential, commercial, and SMSF. And Andrew, can I get you to take us through what that means, the impact that it's having for our commercial offering?
Yeah, thanks, Sam. So starting with our digital alt doc forms. So if I take a step back, we can offer our traditional non-digital alt doc, which would require the credit assessor to call the borrower to talk through and verify the income that they've declared and their business history. and then also make a separate call through the accountant and verify what the accountant has put on their declaration form, and talk through their history in supporting our mutual client, sustainability of income, and so on. Now, fast forward to where we are today with a digital alt doc. It's electronically verified from the borrower's and the accountant's perspective. So when it reaches a credit assessor, that call is no longer required. Everything's being verified digitally, which just means that it's a lot quicker experience. It is a lower touch experience for the borrower, for yourself as a broker, and for the accountant. And it can really enhance our speed to yes and quicken up that approval process. So moving with the times, getting digital, similar to our digital app submission process, being able to apply online. You can also engage our credit support team, broker support, to put an application together for you if need be, but that digital application process is a nice, seamless, fast process. Digital verification can use video ID processes to confirm the IDs that you received, to send that through to us in terms of the ID verification. Again, utilising the modern technology in front of us to have a lower touch, quicker, more beneficial experience for everybody involved. It's great out there. Coming soon, our upfront valuations. We're certainly already enabled that in our consumer space, and coming soon in our commercial space. Just being able to have the valuations available up front for yourselves as brokers will give you a very clear line of sight on how we're going to debt size it, what our LVR looks like, if there's anything in particular that comes up we need regard for in terms of the valuation up front. Again, making the process a lot easier and simpler for everybody. And getting to my favourite one, the eDocs. So we have this across all our product offerings now. Being able to issue electronic documents out to customers. Why do I get excited about it? It's not just the ease, the reduction in time spent, but the reduction in errors as well. Nobody hates having a settlement held up because the last minute we find out there's a signature missing, or in the wrong spot, or any one of a number of things that can go wrong with a manual loan document execution. With the eDoc process, it guides the signatories to where they need to sign, eliminating those errors. It's also a very quick process. We tested this when it launched a little while ago, and we've had at the moment, the record is a 9-minute turnaround. 9 minutes from us issuing the eDocs to our clients, having them execute and return to our settlements team. So as with all records, they're there to be broken. It'd be wonderful if someone someone on this call has an experience where it's even quicker than that 9 minutes. But quick, easy, and error-free. 3 massive boxes to tick there with our e-signing options.
I love how excited you get, Andrew, when you get to that to that point. It is very exciting. So we're going to take you through our Alt Doc Express now. So URL is okay. We are having some wonderful tech issues today. It looks like the URL is not working for the video. So what we will do for that, I might just get you to move to the next slide, Andrew. And what we'll do for everybody on the call today, we'll include a link to the video on its own so that you can watch that Alt Doc Express process. It is just providing you a how-to on how that new process works from the broker's perspective, your client, and also the accountant. So it just runs through that.
It looks so good in our practice run. I'm glad we can still share the link with everybody so they can get to experience that.
Absolutely. But excitingly, we have made some credit policy changes for commercial. We're constantly looking at ways that we can support our brokers with changing and updating policy to make sure we've always got the solutions that you need for your clients. So we have just recently reduced the amount of BAS and business bank statements that we need for our near prime alt doc product. So we used to require 12 months BAS and business bank statements, and now we've dropped to that 6 months requirement. And as Andrew's already alluded to, we can now do that tax debt consolidation requirement as well.
I probably didn't distinguish between prime and near prime when I was talking about tax debt consolidation. So the thing to understand here is if we're taking out the tax debt, there's nothing further outstanding with the tax office. Everything else for the applicant's credit file is clear and clean. Then we do that under a prime. If they do have ongoing tax liabilities, outstanding tax, we can still consider that under a near prime product if we're not taking out that tax debt and financing it ourselves.
Okay, great. And a couple of more updated policies. I might get you to run through this slide for me, please, Andrew.
Yeah, no worries. So in terms of non-standard residential loan limits and commercial lending, what are we talking about there? There's going to be some assets where we don't have the ability to finance them under a standard residential product, but we can offer, in the majority of those cases, the financing of those properties with a commercial product. So still a residential asset, but not a standard residential asset. And I'm thinking some good examples, something with a significant heritage overlay, for example, a terrace house in a metro location that would otherwise not be standard resi because of that heritage overlay. We can certainly still look at a solution to finance that under a commercial product. Default limits, so we have the ability to still fund people with outstanding or cleared defaults under the various types of loan options. Discharge tripping over words here. Discharge bankrupts, we will actually we have the appetite to consider one-day discharge bankrupts. Financial statements, so again, happy to do a full doc under financial statements. I mentioned under near prime the ability to look at the most recent standalone 1 year finance if the last year was a bump year compared with the prior year. We want to look at more childcare centres, and bearing in mind these can be configured both as a residential property that's been approved as a daycare centre, or your more typical or larger commercial property that is a childcare centre, generally at a 65% LVR. And valuations, again, looking at getting them up front to help everybody out with the process. And we've actually expanded our panel of commercial valuers as well, just giving us more options and flexibility in this space.
Yeah, wonderful. And just to, on those childcare centres, I believe we're doing alt doc for childcare centres now as well. And then just to confirm, the default limit has lifted, so we've sort of aligned it with the resi policy now as well. So default limit has lifted to $3,000. So you can have unlimited default up to $3,000 in that near prime product. But if it goes over 3,000, then it does need to be registered for 24 months. So we can accept large default dollar amounts, unlimited amount, but you just have to comply with those dollar amounts. So up to $3,000 or over $3,000. Perfect. Okay. That takes us to the end of today's session. Apologies for all the technical issues today. Sometimes you just can't help it, but we do have the survey that will come to you as soon as we close out the session. It's really important for you to complete that. Please complete it. It just enables us to be able to provide you better support. Thank you so much, Andrew. Appreciate you taking the lead and stepping in when my computer decided to die.
Pleasure.
And thank you everybody for joining us today. You will get a recording of today's session. We'll include that link for AltDoc Express so you can see that process firsthand. And there'll also be a CPD point coming your way in that follow-up email as well, one for FBAA and one for MFAA as well. It'll count for 1 hour today. And thank you so much for Emily, who's on the chat today, answering those questions live. If there are any that we haven't gotten to, we do have the report so we can come back to you offline. So thank you so much, and we'll see you on the next webinar. Thanks, Andrew.
Thanks, everybody.
Thank you.